How much cash does your business actually need? Many business owners answer this question by looking at their current bank balance. If there is plenty of money in the account, they feel safe. If the balance starts falling, they become worried. In this video, you will learn 8 ways to know how much cash your business really needs. Number 1. Calculate your monthly operating expenses. The first step is understanding how much cash your business normally spends every month. Start with the expenses required to keep the business operating, including payroll, rent, utilities, insurance, software, marketing, transportation, supplies, professional services, and other recurring costs. Do not rely on a rough estimate. Review your actual financial records and calculate what the business has really been spending. A business owner may believe monthly expenses are around $20,000, while actual spending regularly reaches $25,000 because smaller expenses were ignored. Once you know your normal monthly cash requirement, you have a starting point for determining your cash needs. For example, if the business regularly requires $30,000 each month to operate, keeping only $10,000 available creates very little room for delays or unexpected problems. But 1 month of expenses should not automatically become your final cash target. This number is simply the foundation. The next question is how many months of those expenses the business should be prepared to cover if revenue suddenly declines or customer payments arrive later than expected. Number 2. Measure your cash flow timing gap. A profitable business can still run out of cash because revenue and cash are not always received at the same time. Your business may make a sale today, but wait 30, 60, or even 90 days before the customer's payment actually reaches your bank account. During that waiting period, the business may still need to pay employees, suppliers, rent, insurance, taxes, and other expenses. This creates a cash flow timing gap. The larger that gap becomes, the more working cash the business may need to keep operations moving. Imagine a business completes $100,000 of customer work this month. On paper, the revenue looks strong, but customers are allowed to pay 60 days later. Meanwhile, the company must pay $50,000 in payroll, materials, and operating expenses before those customer payments arrive. Review how long customers normally take to pay you and compare that with how quickly your business must pay its own bills. If you regularly pay suppliers in 15 days, but customers pay you in 60 days, your business is financing a 45-day gap. The objective is to estimate how much money must remain available while cash is temporarily trapped in accounts receivable, inventory, unfinished projects, or other parts of the operating cycle. The longer your cash remains unavailable, the larger your working cash requirement may become. Number 3. Build a minimum cash reserve. There is no universal cash reserve amount that works for every company. A business with predictable recurring revenue, low fixed costs, and reliable customers may require a different reserve than a company with volatile sales, expensive equipment, seasonal demand, or a small number of major customers. Suppose your essential monthly expenses are $20,000. A $60,000 reserve represents approximately 3 months of those expenses. Now, the reserve has a practical meaning. It gives management an estimate of how much time the company could continue covering essential obligations during a serious disruption. Your minimum cash reserve should also reflect how quickly the business could respond to a problem. If expenses can be reduced quickly, the required buffer may be smaller. If the company has large leases, payroll commitments, debt payments, or contracts that cannot easily be reduced, more cash protection may be appropriate. Number 4. Prepare for seasonal revenue changes. A retailer may generate strong sales during the holiday season but experience much slower months afterward. A landscaping company may produce most of its revenue during warmer months. A tourism-related business may experience dramatic changes depending on travel seasons, weather, or local events. The problem is that expenses do not always fall as quickly as revenue. Rent, insurance, software, debt payments, key employee salaries, and other costs may continue even during slow periods. The company therefore needs enough cash from stronger months to help finance weaker months. Look at least one complete annual cycle and identify when cash inflows are usually strongest and weakest. Then compare those patterns with expected cash outflows. This helps you identify the months when the company's cash balance is most likely to experience pressure. For example, a business may appear financially strong in December because it has accumulated $100,000 in cash. But if January through March historically produce weak sales while operating expenses continue, a large portion of that money may already be needed to finance the upcoming slow season. Number 5. Calculate the cash required for growth. Growth usually sounds financially positive. More customers, more sales, and more revenue should make the business stronger. But growth can actually increase your cash requirement before it increases the amount of cash available in your bank account. Imagine your company receives a large new order. To fulfill it, you may need to purchase more inventory, hire additional employees, increase production, spend more on shipping, or invest in equipment. Those expenses can happen weeks or months before the customer finally pays you. This means rapid growth can consume cash, even while revenue is increasing. The business may look successful on the income statement, while the bank account becomes increasingly tight. This is sometimes called a working capital problem because additional business activity requires additional money to keep operations moving. Before expanding, estimate the cash required to support the growth itself. Calculate additional payroll, inventory, equipment, marketing, facilities, technology, shipping, and other costs that must be paid before the new growth begins, generating enough cash to support itself. For example, suppose a business plans to increase monthly sales significantly. That sounds attractive, but achieving those sales requires an additional $40,000 of inventory and $20,000 of operating expenses before customer payments arrive. The business may need $60,000 of additional cash just to support the expansion. Number 6. Include taxes, debt, and large upcoming payments. Some expenses do not happen every week or every month, which makes them easy to forget when estimating cash needs. Taxes, debt payments, insurance premiums, annual subscriptions, equipment purchases, bonuses, and other large obligations can suddenly reduce the company's bank balance. A business might have $80,000 in cash and assume that the entire amount is available. But if $30,000 will soon be required for taxes and another $15,000 is committed to upcoming debt and insurance payments, the truly available amount is much smaller. This is why cash should not be treated as one large, unrestricted number. Some of the money sitting in your account may already have a future purpose. Mentally spending that money twice can create serious cash flow problems. Create a schedule of major upcoming payments for the next several months. Include estimated tax obligations, loan payments, insurance renewals, equipment purchases, annual software contracts, bonuses, supplier commitments, and any other known expense that could materially affect cash. You can even separate cash into different planning categories. One portion supports normal operations, another protects the emergency reserve, another covers taxes and major upcoming obligations. Additional cash may then be available for growth, investment, or distributions. Number 7. Adjust for business risk and unexpected problems. Even the best financial plan cannot predict everything. Equipment can fail, a major customer can leave, sales can decline unexpectedly, a supplier can increase prices, an important project can be delayed. An economic slowdown can reduce demand. Your cash target should reflect the level of uncertainty surrounding your business. A company operating in a stable industry with diversified customers and predictable recurring revenue may be able to operate with a smaller safety cushion than a company facing significant uncertainty. Customer concentration is one important example. Imagine that one customer generates 40% of your company's revenue. Losing that customer could immediately create a major cash flow problem. That business may need a stronger cash reserve than one with hundreds of smaller customers. The same logic applies to equipment-dependent businesses. If one critical machine stops working and replacement costs are high, the company should consider that risk when determining its cash needs. Otherwise, a single breakdown could force the business to borrow money under pressure. You should also consider how easily your company can access outside financing. A business with an established credit facility may have more financial flexibility than a company with no borrowing options. However, available credit should not automatically replace a reasonable cash reserve. Think about the 3 or 4 financial problems most likely to hurt your business. Estimate how much cash each problem could require and how long the company might need to recover. You do not need to prepare for every imaginable disaster, but you should prepare for realistic risks. Number 8. Build a rolling cash flow forecast. The final and most practical way to determine how much cash your business needs is to build a rolling cash flow forecast. Instead of looking only at today's bank balance, a forecast shows what could happen to your cash over the coming weeks and months. Start with your current cash balance, then estimate when customer payments and other cash inflows are expected to arrive. Next, estimate when payroll, rent, suppliers, taxes, debt payments, inventory purchases, and other cash outflows are expected to leave the business. The result gives you a projected cash balance over time. You may discover that your company has plenty of cash today, but could experience a shortage several weeks from now because multiple large payments occur before customer collections arrive. For example, imagine the business currently has $70,000 in cash. Looking only at today's balance makes the company appear comfortable. But the forecast shows that payroll, inventory, taxes, and supplier payments could reduce the balance to $15,000 before major customer payments arrive. Now management has time to respond. The company might collect invoices faster, delay a non-essential purchase, negotiate supplier terms, reduce unnecessary spending, or arrange financing before the shortage becomes an emergency. Update the forecast regularly because business conditions constantly change. Customers may pay earlier or later than expected. Sales may rise or fall. New expenses may appear. A rolling forecast keeps extending forward, so management always has visibility into the next financial period. A cash flow forecast turns your cash target from a guess into a management system. Instead of choosing a random amount to keep in the bank, you are estimating how much money the business will actually need based on timing, expenses, commitments, risks, and future plans. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.